Right, good morning, everybody. Welcome to this morning's K3 Hub webinar. Thank you very much for joining us. If you've not met me before, my name is Marie Wadeson and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the group. Now, at this point, I normally tell you a little bit about the K3 Capital Group, but I can see there's a slide on the screen that's going to do that for me. So I thought I might just tell you a few things that are going on at the K3 Capital Group at the moment. So we are all gearing up for our year end. That's 31st of May. It's been a big few weeks within the group. So we've seen the group ranked as #1 deal advisor in the UK with Experian, Refinitiv, and the LSEG. That's many years in a row that we've held that title. We've just completed an acquisition just this week, indeed. Completion of a software advisory firm, Alpha Logics, who joined our Pinnacle business that joined the group earlier this year. So that's a very welcome addition. And I guess we all can't fail to have seen the global financial turmoil that's been rolling out over the last few weeks and kicking off properly this week. We have seen a significant uptick in members asking us for help in supporting some of their distressed clients. So I just thought that would be a useful backdrop for you as to some of the things going on in K3. Before I introduce you to today's speaker, I thought I'd just run through some housekeeping. We are recording today's session, as you will have seen. As with all of our previous recordings, they will be posted on the K3 Hub and Quantuma websites. That'll be done next week. Q&A is open for questions. However, we do ask that your questions are relevant to the course and so on topic. I know that we've got a very full course today and the speaker's going to have to prioritise the questions that he gets to. So if we don't get to your question, please forgive us. Preference is that you use the Q&A function to ask your questions rather than the chat, just so that we've got all the questions in one place. Hopefully by now you will have seen that there is a copy of the slides and accompanying notes that's been placed into the chat. If that's not quite there yet, it will be shortly. We'll put that in there a few times throughout the session, just for those who might arrive slightly late today. We appreciate today is a long session and therefore we will be taking a couple of comfort breaks and Malcolm will signal those. They'll be sort of there or thereabouts on the hour. Anyway, on to today's webinar. So I am very pleased to be able to welcome back Malcolm Greenbaum. Some of you may recall that Malcolm delivered some very popular VAT sessions back in 2023. So popular indeed that we had to run them twice. Malcolm is a chartered accountant and chartered tax advisor. In the past, he has lectured on IFRS, US GAAP, UK tax, VAT, and has experience in delivering bespoke training sessions to businesses operating across various sectors. Today, Malcolm will be covering a number of areas and hot topics, including most recent developments in VAT, VAT in relation to land and buildings, business splitting, also known as disaggregation, and also cross-border services. Just before I go, a quick word about forthcoming K3 Hub events. We have a packed CPD and non-CPD event schedule this year. Some of the topics that are coming up include understanding accounting requirements of LLPs, calculating inheritance tax, a LinkedIn masterclass, and commercial property taxes. Invitations are sent out on a very regular basis, so do keep an eye on your inbox. We also promote webinars on the K3 Hub website and Quantuma website. Hope you enjoy today's session. Wishing you a great weekend. And Malcolm, thank you for joining us, and over to you.
Thanks very much, Maria. Very good morning to everybody. Welcome to this VAT update and discussion around some topical issues that I'm receiving consultancy queries about over the past weeks and months. The slides, a copy of the slides have been posted into the notes, or the chat, sorry. I'm sure it will be regularly reposted because obviously if people join after, I think it's put in the chat, they miss that particular attachment. So it'll be put back on there at regular intervals during the morning to catch those people who are slightly later joining than others. As Marie said, if you do have any questions at any time, please do put them in the Q&A if you can, rather than the chat. I've got both open, but if you put in the Q&As, as Marie said, we'll have them all in one place. If you can keep the questions to the topics we're discussing rather than just random VAT queries, that would be very helpful. But if you do have an urgent query about VAT, which we're not covering, do stick it in the Q&A, but I can't guarantee that we'll have the time to cover it during the short amount of time that's available to us this morning, based on what we're trying to get through. So, as Marie mentioned, we're going to start by looking at recent developments in the world of VAT, particularly recent case law decisions that may have impacts on a fairly wide variety of clients. We're going to look at land and buildings and just remind you of some of the key principles around the VAT treatment of land and buildings transactions. And there are a few golden rules, which if you can remember, can help to narrow down the correct VAT treatment at the very beginning. We'll talk about business splitting or disaggregation, as Marie said. I just got a number of queries recently about that, so I thought I'd cover it. And also, I constantly get queries over how VAT works when it comes to cross-border service provision. And as we'll find out in some of the recent developments, the European Union, from the start of this calendar year, has changed the place of supply for live stream events, where the consumer is not a business customer. And the UK hasn't changed its rules, and that's going to create some issues for UK live streaming businesses and create some advantages competitively for foreign live stream businesses where some of their consumers are in the UK. So that's the plan for this morning. Let's crack on because we've got a lot to get through. In terms of recent developments, I thought I'd bring this case to you because it just raised a point which seems a bit odd at the beginning. And whilst the company won the case in this particular instance, the European court did say something which might have ramifications in other similar but different situations. So the company concerned is a company called SC Adient, and it's a group, it's an Adient group. And they have a German company and a Romanian company, and they're a very specialized business. They manufacture seats for cars and vans. And the Romanian part of the group supplies manufacturing services. It doesn't actually ever own any materials. The materials are owned by the German company. They're given to the Romanian company to manufacture into, let's say, seats, and then delivered back to the German customer for installing into vehicles at some point. But all the Romanian company does is invoice for the services, the manufacturing services that it provides. Now, we're going to talk about cross-border services later, but the general principle, if you're making a business-to-business service supply, is that the place of supply is where the customer is located. So if the Romanian business is supplying services to a German business, then ordinarily the place of supply, in the absence of any special rules, is going to be Germany. So the Romanian company treated the supply as being outside the scope of Romanian VAT and expected the German company to then apply a reverse charge to the services that are received. Because if the place of supply is Germany, then German VAT needs to be accounted for. And if German VAT needs to be accounted for and the customer is a business customer, then the German customer deals with that. And that's how we have reverse charge. The Romanian tax authorities had a different view. They argued that the German company actually had a fixed establishment in Romania created by the Romanian company. In other words, this is a bit hard to get your head around. The Romanian company is supplying services to a fixed establishment of the German company in Romania, but the fixed establishment is essentially the Romanian company, which means it's kind of supplying services to itself. So it's a bit mind-bending, if you like, in terms of concept. So the Romanian authorities say, like, you've made a supply, a domestic supply in Romania to a Romanian fixed establishment of a German company, i.e. yourself. And therefore, we think you should be charging Romanian VAT. So this matter got referred from the Romanian courts to the European Court of Justice, which said that you can't just say that there's a fixed establishment in another jurisdiction just because they are part of the same group, or just because the Romanian company's only customer is this German group company, because all of its services are provided to one customer, the German group company. Now, in this case, as I say, the court found that the arrangement didn't create a fixed establishment in Romania, so reverse charge was the correct treatment, but the European Court did say that it is in principle possible that you can create a Romanian fixed establishment, to use this example, but that would be the case if the recipient, that is the German company, had technical and human resource of its own, which means that it would have to essentially control the Romanian company to such an extent that the workers were effectively working for the German company, not the Romanian company. And the European Court, in this case, decided that that wasn't the case. The Romanian service provider basically was allowed to get on with it as long as they met certain quality thresholds. They were allowed to do what they liked in terms of the manufacturing process. But had it been slightly different, we could end up in a situation where a domestic company creates a fixed establishment for a foreign company, particularly a member of the same group, by virtue of essentially being controlled day to day by that foreign entity. And I had a client quite recently that was concerned that they'd have a similar problem. They are based in the UK. They have certain services which are provided in Italy, and they've sent some of their own staff out to Italy to help run that operation. And that operation uses software, because it's a trading company, uses trading software, which is proprietary to the UK office. And they were concerned that as a result of this case, the Italian tax authorities may think that they've created a fixed establishment for themselves in Italy. So when Italy provides services to the UK, that might be subject to Italian VAT. So we had a discussion about the degree of control. And I think in that case, my client's case, there was more control being exerted from the centre than was the case with Romania. So we established there was a VAT risk that at some point the Italian authorities may demand that local Italian VAT be charged for what was an intergroup service being provided to the UK. So I think this will have resonance in due course. Caroline, thanks for the question, very relevant. You cannot have a group registration which is cross-border, no. You can have a VAT grouping where you have establishments in the same jurisdiction, but not cross-jurisdictional, no. Had they had a group registration in place, and it was within one jurisdiction, that might have made a difference. What would have to happen here, Caroline, is that the group would have to apply, if Romania was right, and there was a fixed establishment of the German company in Romania, then the German group would have to apply to the Romanian authorities to add that fixed establishment to the VAT group. And then the transactions would be disregarded for VAT purposes. That would be a fairly tortuous process, I think, to try and get that in place. But no, to answer your question, you can't have cross-border group registration. Okay, let's move on. While we're talking about services, this change, I think, could be very, very significant indeed. The European Union has changed the way that it's going to tax B2C, that is, supplies to non-business customers of live streaming and virtual events, where obviously there's a charge for those events. Now, it says that the place of supply of cultural, artistic, sporting, scientific, educational, entertainment, or similar activities, including organizational services supplied to a non-taxable person, is the place where the activities actually take place. Okay, that's not a major change. The major change is where the services relate to streamed activities or virtual activities. In that case, the place of supply when supplied to a what's called a non-taxable person, we call it a non-business person, is the place where that non-taxable person is established. If they're not an individual, they're, for example, a charity that doesn't have any business activity, or if it's an individual where they have their permanent address, and if they don't have a permanent address, or they have more than one permanent address, then where they usually reside. That is not the same as where they're watching the virtual event necessarily. They could live in Germany and be watching this virtual event whilst on holiday in Spain. The place of supply of that service would be Germany, because that's where they normally live. That's where they permanently live. So it's going to create a very tricky environment for suppliers. Because if I sign up for a live virtual event as an individual, so not in connection with a business, know my where to send the invoice or whose VAT they should account for, they're going to have to ask me for my permanent address. They can't rely on the IP address that's used when I access the event. A, because I could be somewhere else and not at home when I'm watching it, and B, because I can use a virtual private network and they will think I'm in one country when actually I am not. So suppliers of virtual events to non-business customers will have to capture the permanent address of those customers. Or if they have more than one, the place where they usually reside, the place they stay in the most, because that will dictate where that supply takes place for VAT purposes. Now, the UK hasn't changed. So we will still say that the place of supply in this situation is where the event takes place, because we don't have a special rule for live streaming. And therefore, it follows the general rule that when you're supplying a non-business customer, the place of supply is where the supplier belongs. So in this case, where the event takes place. And that opens up the possibility of double tax or no tax at all. And that's where UK businesses may run into problems and foreign businesses will make hay. They'll have a great time. So let's just show you the two examples. Firstly, double VAT. So let's say that your client or you are a UK company and you are providing a live streaming event. And let's say that a particular individual or bunch of individuals who are watching it, they live in France. Their permanent home is in France. So according to the UK VAT law, the supply takes place where the event takes place, which is likely to be where the supplier is. So HMRC will say that's a supply taking place in the UK and we'll have some UK VAT on that supply. Thank you very much. But the French authorities, being part of the European Union, will say, well, we've just changed our law. And so under our law, the place of supply of this service is where the customer belongs, because they're a non-business customer, and therefore we want French VAT. Thank you very much. Now, let's say, for example, that, well, we know the UK VAT rate will be 20%. Let's just say that the French VAT rate would be 25%. And we charge £120 for attending the event. And if we're supplying a non-business customer, the 120 quid will include all the VAT. So out of that 120, we have to account for UK VAT of 1/6. So that's 20 quid going to HMRC as UK VAT. But the French will say the 120 quid includes French VAT. And if their rate of VAT for this supply happened to be 25%, then they would want 25 1/25. They'll want a fifth of the £120 as well. So they'll want £24 worth of VAT in France. So out of the £120 ticket price, the supplier has lost £20 in UK VAT and £24 in French VAT. So their net revenue is only 120 minus 20 minus 24, 76 quid out of the 120 they charged. Now, for the UK company, they can make their VAT compliance easier by signing up to the European Union one-stop shop. So they could register, and I would recommend registering in Ireland for the one-stop shop, because that means that all of the guidance, all of the forms are in English. They could register with the Irish authorities for one-stop shop VAT. They're not registering for Irish VAT, they're registering to use the European Union's one-stop shop. And every quarter, they'd file this return with the Irish tax authorities saying during this quarter, we supplied live streaming events to non-business customers in Austria, Belgium, Germany, Netherlands, Bulgaria, Estonia, Latvia, Lithuania of this value. This is the VAT rate in those jurisdictions, and this is the VAT we therefore owe to each of those jurisdictions. And then they just transfer one sum of money to Ireland, and the Irish then have to distribute that money to the various tax authorities concerned. But it does mean capturing the permanent address of the customers who are paying for the live streaming, and then filing this special return every 3 months with the Irish tax authorities. Quite a burden. Now, on the other hand, we may have a situation where there is a French company and they are producing a live streaming event, which is to a non-business customer who's in the UK. So the French VAT law says place of supply, based on European law, is where the customer normally resides. So the French will say that supply takes place in the UK. No French VAT is due. The UK will say our VAT law is that the supply takes place where the event takes place. In this case, we'll assume that's in France, where the French company is based. They'll say that supply takes place in France, it's outside the scope of UK VAT, and nobody will want any VAT. Which means if the French company charges 120 quid to UK non-business customers, they keep the whole £120 as their revenue. So the UK company doing the other way around keeps £76, the French company keeps £120. So it makes UK businesses very uncompetitive in this arena compared to businesses in other jurisdictions. So what's the solution? Anybody have a solution for this? To try to make UK businesses more competitive? I can think of at least a couple of solutions. I'll give you a time to type anything if you're typing in the Q&A. Well, one solution might be that the UK changes its VAT law to match European Union law. And then we won't have a black hole or double taxation because we'll have the same rules that they have. There's no sign that that's going to happen because we knew this law was changing quite a long time ago now. And therefore, I don't think the UK plans to change its law anytime soon. So another possible solution might be for the UK business to operate the live streaming events where if they're selling to European customers, they sell via some kind of agency in Europe. So they have a business relationship with an agency in Europe that sells the tickets for the live streaming event, and the UK business will invoice the foreign business. Well, that's a B2B supply. So that doesn't fall within the same rules as the ones I've just explained. And in that situation, the invoice would have no VAT, and the foreign business, the European business, would then reverse charge it. So in that way, the UK business can get more revenue than would be the case by invoicing the non-business customers directly. So using a business agent in Europe might be something. I mean, they're going to charge a fee, obviously, but the UK company may end up with more net revenue than if they have to account for double VAT. So there are solutions to these problems, but they involve cost. Okay, there's no question that UK businesses will be at a disadvantage to European businesses when it comes to the provision of live stream events. Okay, let's move on. I've had a lot of questions over the past 12 months around the tour operator margin scheme, And that is principally because of this case. So tour operator margin scheme is a mandatory scheme if you offer a package of supplies similar to those offered by a travel agent, where you buy in relevant supplies for the direct benefit of a traveller. And that means that they have to be supplied to the traveller, the customer, without material alteration and without further material processing. And the case that's just been decided again by Upper Tribunal is a case called Sonder Europe Limited. And Sonder would rent in residential accommodation, so for example, a flat, for between 2 and 10 years. So it'd enter into 2 to 10 year leases, so long-term leases to bring in flats that they could then use. Then they would grant licenses for short-term accommodation to their customers. Now, when it comes to renting residential accommodation, the general principle is that if you rent residential accommodation, that is an exempt supply for VAT purposes, and no option to tax can change that. So Sonder is not paying VAT to the landlords from whom it's leasing these properties, but it's supplying holiday accommodation to its customers. And holiday accommodation is specifically standard rated, And therefore, what it wants to avoid is a situation where it's renting in the property and it's paying rent without any VAT consequences. But when it rents out the flats as holiday accommodation, it has to account for 1/6 of the output VAT, of the charge as output VAT. Okay, 1/6 as output VAT. So it's going to lose 1/6 of its revenue from the customers, but it doesn't have any input VAT to recover on the rental going out to the landlords. So that's going to create an economic problem for it. So it says that it should be able to apply the tour operator margin scheme, which means it should be able to take the difference between the revenue from the accommodation that it earns during a period, during a quarter, minus the rent that it incurs during that quarter, and take 1/6 of the margin. Even though it's not paying any VAT on the rent it's paying, it should be able to use the tour operator margin scheme. The first tier tribunal accepted the company's argument that it was eligible to use TOMS. So HMRC appealed that decision, and very recently the upper tribunal ruled that in this case there is a significant difference between what's being bought in and what's being sold. Okay, the supplies by Sonder having bought in. Enver, you can't see the slides. Could I suggest that you go out of the meeting and come back in again? Because that will often cure that. I presume everybody else can see the slides, I'm presuming. Nobody said they can't. Okay, just try going out and come back in again if you can. So the upper tribunal said that the supply has been by Sonder, well, having leased in the property for 2 to 10 years, that's essentially now its property. So when it onward supplies it, when it supplies holiday accommodation from that, it's supplying something which is already its own. It's not supplying a bought-in service. And therefore, it's said that TOMS doesn't apply. Now, this is really important from a business, from a commercial perspective, because I've had a number of people ask me for advice, normally accountants acting for their own clients. That's my main consultancy business, saying that if their clients are forced to charge output VAT on the amounts they charge for these short-term rentals out, and they can't use TOMS, they can't actually make a profit out of the rental. So having leased in property to rent out in the long term and paying regular rent for leasing it in, they're not going to be able to turn a profit. In some cases, they'll be making quite a big loss because they're losing 1/6 of their revenue to output VAT and there's no VAT to recover on the inputs on the leasing in. Now, whether Sonder will appeal this to the Court of Appeal, I rather suspect they will, because the first tier tribunal decided that they could use TOMs. The upper tribunal has decided that they can't. So it's kind of 1-1 at this stage. And so they might decide to go to extra time in the Court of Appeal. And I imagine they'll probably be able to raise crowdfunding to fund that appeal, the lawyers' fees for that appeal, because there's a whole load of interested parties waiting for a firm outcome to this particular problem. Having said that, it was too late to include it in the slides because it's very recent. But Bolt, the sort of taxi app, recently won its appeal again that it can use TOMs. Because if you book a taxi, a private hire vehicle, using the likes of Uber or Bolt, then essentially they connect you with drivers. They ask all their drivers, do you want this job? And if the driver accepts, the driver comes and picks you up and drops you off where you've said you want to go, according to the app. And the courts have recently held that Uber, or Bolt in this case, are buying in a service which they're just reselling to you. HMRC's argument that they're changing it substantially on the basis that they are providing the software that links it together and they're charging for that service, that didn't hold any water. Because if you order a cab on Uber or Bolt, then many people consider their relationship to be largely with the driver. That Uber's got the driver to them, but the driver is the key player in this, not Uber or Bolt. So in the case of Bolt, they seem to be able to use the TOM scheme, but in the case of renting in long-term accommodation and renting it out, you can't. I had more queries about TOMs in the last 12 months than in the previous 30 years combined, mainly as a result of this case going through the courts. Okay, other developments. With effect, or since the 5th of August last year, if you want to change the VAT registration details of a client, you have to use your agent services account to do so, whereas in the past, we would have filed a form, VAT 484, or we might have written to or emailed HMRC. The only way you can change details now is through the agent services account. If your clients want to change their details, for example, their registered address, if they've changed the name of the business, then they have to make that through their digital VAT account. If anybody is digitally excluded, then HMRC will support them through other channels, apparently. Now, one of the biggest changes to occur in the VAT world in recent history is the requirement for private schools to charge VAT on, I'd say, most of their fees from the 1st of January this year. This is still being challenged in court, by the way. But schools would have had to file their first VAT returns by now. Changes to the VAT quarter, is that by the digital account as well? As far as I'm aware, Mark, it's a good question. If I want to change my, I think you mean your stagger period, so when your quarter runs to, do you use the digital account for that? The notice was just simply your details. So I don't know whether that would include changing your quarter as well. I would try it. So if you go through the agent services account and see if it lets you change the stagger period, I haven't had any requirement to look at that aspect of it since the changes came in. So I honestly don't know the answer to that question. If anybody else does know, feel free to write your comments into the Q&A and I'll read them out. So private school fees. The VAT exemption no longer applies to school fees from 1st of January 2025 under the legislative changes. There was a lot of debate and discussion around the law if parents or grandparents had prepaid fees. The way the law is, a parent, grandparent had prepaid fees for specific terms before the 29th of July last year, then that prepayment would remain exempt. Bear in mind, by the way, that that prepayment does relate to future services, but the kind of tax point would be created when the payment was made, and at that point, it would be exempt. Standard rated VAT needs to be charged on all educational services and vocational type services supplied by a private school. Oh, thanks, Phil. You can change most details for a client for VAT via the agent services account, but you can't change the bank details. Thank you very much indeed for that answer. So by implication, it seems that you can change this, you can apply to change the stagger period via the agent services account. Okay, so supplies of education by a private school for what are called school-age children, and that can be different if you're in Scotland, Ireland, Wales, or England, but for school-age children, if you're a private school, that will be a standard rated supply. And there's a special rule, so they can't contract out supplies to connected persons who might be able to supply exempt supplies, that you can't get around it that way. So I'm not going to get too concerned about the connected persons. It's an anti-avoidance rule, and most schools know that it's not going to work, so they're not going to do it in any case. Where a student would ordinarily be educated in the private sector, but their needs can't be met there, so the local authority places them in a private school, and the local authority is paying the bill, the school still needs to charge them VAT. The authority may well be able to recover that VAT because it's discharging its statutory duties. So under Section 33 of the VAT Act, it should be able to recover it, but the school still charges VAT. Any fees charged by nurseries, that is for children who are below school age. So I think that is the years preceding reception in England. Even nurseries attached to private schools are still VAT exempted. So as I say, standard rating only applies to the first year of primary school onwards. So in England and Wales, that's reception. In Scotland and Northern Ireland, it might work slightly differently. Now, there was a question asked because the original legislation or draft legislation said that if there's any child in a nursery class who is of primary school age, then all of the fees charged in that school, in that nursery, had to be standard rated. And so people said, well, what about children who need to be kept down a year because they have delayed development? And so the law was changed. So it now says that as long as all or almost all of the children in nursery are below primary school age, then the fees are still exempted. So if there's one, maybe two out of a class of 25 or 30 in the nursery who've been kept down, the fees are exempt from VAT. Education and vocational training at a private sixth form college, standard rated. Standard rated. The exemption that you might have come across occasionally, where a private tutor supplies education which has been commonly taught in a school, college, or university, is not affected. That has caused some concern because what if they're supplying their private tuition in a school environment? So they go into a private school and they supply private tuition. What if the schools ask them to come in and provide private tuition to the student of a parent? Does that still count as exempted? And I think if I remember rightly, Dean Wooden wrote an article about this in last week's, was it last week or the week before's Taxation magazine? Because there is a difference of opinion, and to be honest with you, the law is not at all clear on that point. I would argue that if the parent is paying for the private tuition, it's an exempt supply. If the school is paying for it, then they're contracting in that work, and I would argue that that supply would need to be standard rated. That's my view, but it's not the only view by a long way. Boarding fees and any educational extracurricular activities, so which form part of the child's education, are also standard rated. But any other services that are closely related to education remain exempt from VAT. So if the school arranges transport for the children to and from school, so if the school arranges it and they charge a separate fee for it, that will be exempt from VAT. The coach company charging the school just charges the normal VAT, if any, they have to charge. It may well be that the coach company zero rates its supply to the school because they're transporting more than 10 people on this coach. Any compulsory lunches. So if the school charges a mandatory extra fee for lunch, then that is incidental to the supply of education. It's not education itself, and is exempted under the law. Which means that if the school incurs any input VAT in relation to the supply of those lunches, for any services they receive, for example, they can't recover that VAT, and nor could they recover the VAT on the cost of any kitchen equipment used to supply those lunches. Any before or after school childcare, any things like breakfast clubs, holiday clubs, they count as welfare services, not education, and they remain VAT exempt as they have always been. And you can see, therefore, that schools are very likely to be private schools are very likely to be partially exempt. And if they organise school trips where they buy in things like coach travel, they buy in things like, I don't know, theatre tickets, museum tickets, zoo tickets, they buy in food, catering for the students, they buy in hotel accommodation perhaps for the students, and then they charge the parents. Well, that means that they are operating, as tour operators. So they'll have to operate the tour operator margin scheme as well. So private schools have gone from needing to know virtually nothing about VAT to actually knowing more than most businesses ever have to know about it. Now, some of the main issues that I've come across in advising finance managers and CFOs of private schools is, firstly, identifying the prepaid fees from last year as either exempt or standard rated. And to do that, you have to identify the tax point or points for prepaid fees. And it's quite complicated because if you read the words of the law is not particularly big here, but if you read the words of the law, as we learnt earlier, if it was pre-29th of July last year and it related to specific terms, then the tax point is when it was received, and at that point, it was exempt. If the fees were prepaid from the 30th of July, because the 29th of July is when the Chancellor, or sorry, the 30th of July is when the Chancellor announced that private schools would be standard rated, until the 29th of October, the day before the big budget last year, then the tax point for those prepaid fees is the later of 1st January 25, or the start of the relevant term or terms to which the fee or fees relate. So they're going to be standard rated, and the tax point or points depends on how many terms worth of fees were prepaid. If it was more than one term's worth, then there'll be separate tax points for each of those prepaid fees as and when the term begins. If the fees were prepaid from budget day last year onwards, then there's one tax point, which is the later of 1st January 25, or the date when the first term commenced, on or after that date. So it'll be early January 2025. So that's one very tricky problem for them. Partial exemption, well, even if they don't have these other exempt services, they've still got to cope with these exempt fees. And it's just a good chance to remind you, generally around partial exemption, that there is a standard way to work out the input tax you can recover if you make a mixture of exempt and taxable supplies. Generally, it's based on the ratio of the standard rated supplies to the exempt supplies in that particular period, in that particular quarter. But if that would not produce a reasonable result, there is a statutory override which the business has to apply. That's not a special method. That's just to make the method reasonable. So you're not applying for a special method. Janet, when you say, can we download the screens, I think you mean the slides maybe. The slides are being put into the chat on a fairly regular basis. If you joined after the previous time, then they'll appear as a PDF file a little bit later on. So this is different to applying for a special method that you don't think a turnover basis is a reasonable basis. You want to use something else like floor area, number of employees in each part of the business. That's a special method. This is just saying that you're not looking for a special method per se. You're basing it on turnover, but the basic methodology doesn't produce a fair result. You have to use a different method. So in this case, if a parent-grandparent has prepaid fees before 29th of July 24, so they are exempt supplies, they still relate to specific school terms. So they still relate to the inputs, the purchases the school has been making in providing educational services. So what the private school has to do is to treat the prepaid exempt fees, even though the tax point is actually back in July last year, it has to treat them as supplies being made in the relevant terms they relate to get a fair ratio of exempt supplies to taxable supplies made each term, each quarter, if you like, for VAT purposes, so that the input VAT that the school incurs that term can be fairly apportioned to exempt income and taxable income. So you have to apply a statutory override to the normal partial exemption rules. And as I say, if a school organises a trip and it buys in a package of services and then sells it to the parents, it has to apply the tour operator margin scheme. So private schools have their work cut out to deal with all of the VAT issues that have come their way over the past few months. It'll be interesting to see how the court case around the fact that this might breach human rights in terms of charging VAT plays out. I rather suspect that the law won't change. So I rather suspect that VAT will continue to be charged. But if the case is successful, then I dare say HMRC might appeal that, by the way. But if we get to a result where it was unlawful to charge VAT, then all of this stuff would have to be unwound later. Who's going to pay for that if it does happen? The schools. Okay, onwards. We see a lot of cases coming to court about the status of certain food and certain drink. Now, it was a bit too late to include it in these slides, but there's been a case that's been rattling around the courts for a while now to do with giant marshmallows. Because as the law originally stood, mini marshmallows that you incorporate into things like cakes and whatever, they are just treated as being normal food because you don't eat them, you don't generally eat them raw. They're incorporated into another project, so they're zero rated. Regular marshmallows that come in packs of sort of, I don't know, 5 or 10 that you eat as a snack, that's confectionery, that's standard rated. And previously the courts had held that giant marshmallows, which you tend to barbecue, roast before you eat them, the company manufacturing them said that they were not confectionery because you didn't just pick them up and eat them, you roasted them. They were sold in the barbecue foods section, so they weren't being sold as confectionery. But I think they're still sweet. I don't eat them, but I think they're still sweet. So the most recent court decision is that giant marshmallows are confectionery because confectionery is defined, it's defined within the VAT law as something sweet which you ordinarily eat with your fingers. That's confectionery. And people will generally eat marshmallows, giant marshmallows, with their fingers, and apparently they are sweet. Apparently that's the case. You might toast them over a barbecue, but apparently they're still sweet. So that saga continues because it will be appealed again, I'm sure. But it just shows the nuances that sit within the VAT law if you have clients that, for example, develop new items that are drunk or eaten. In this case, the company created something called Skin Aid. I don't know if any of you have tried Skin Aid. They said it's a uniquely formulated drink, while a beverage is standard rated. So calling it a drink should mean perhaps that it's standard rated. They said to be used as part of your daily skincare regime. It apparently contains marine collagen. Doesn't sound particularly tasty, marine collagen, I have to tell you. I haven't tried it, but it doesn't sound particularly attractive. But they include flavouring and preservative to mask the taste. So I presume it does taste quite disgusting. Back in November 2020, having originally accounted for output VAT on their sales, the company submitted an error correction notice to HMRC, claiming that the product should be zero rated and asking for a refund of the output VAT they have paid for all of the quarters from December 16 through to September 20. And that totaled some £1.25 million of output VAT. HMRC refused the claim, not on the basis that this was a beverage, but on the basis that it was a beauty product. It was sold, they said, in beauty salons and cosmetic clinics. The product was never sold to a food supplier, so it couldn't be considered to be basic food or drink. The product itself had won industry awards for cosmetics, for being good for your skin. So the first tier tribunal decision, which is very helpful, it's quite specific, but it's very helpful in establishing some decent principles here. The first tier tribunal said it would be zero rated if it was food of a kind for human consumption. And you can solve a lot of VAT questions, almost all VAT questions, by answering three questions. Who is supplying what to who? And the what itself can be more easily understood by taking the view of a customer for the product and asking the question, what do they think they're buying? When they buy it, what do they think they're buying? Because that's almost certainly what is being supplied. And that can help you to answer not just what's being supplied, but whether it's a multiple supply of different things or a composite supply of just one thing. So that's what the tribunal did. The judge said, well, what would a broad-minded VAT payer, your reasonable person on the street, if you can find one, what would they think this drink would be? And in considering the name, the nutritional value, its taste, and whether it had to comply with food and safety regulations, the judge decided that you would more likely find this product in a chemist's shop than a grocer's shop, and therefore it wasn't food and drink. It was marketed as a skincare product. It wasn't marketed as something to quench your thirst or something that tastes lovely and that's why you want to drink it. So the judge found that a customer, your standard customer, would have thought they were buying a skincare product. And therefore it's not food and drink, it is a beauty product, and it's therefore standard rated. So it's a good look at food and drink, but also just the approach to working out what is being supplied. Seen a lot of cases recently where the business claims to be providing healthcare services, which are exempt. To be healthcare, it has to involve the cure of a condition, or the maintenance of a condition, or the alleviation of a condition. And as a general rule, any business that's treating hair loss would not be considered to be health care. And there was a recent case involving a company that supplied hair loss treatment to people who suffered with severe alopecia. But what HMRC will look at and the courts look at is how the services are marketed and whether the person is referred by a medical professional. Because if the person is suffering from adverse mental health, because of the effects of alopecia, and the medical professional recommends that something is done about that, and that is all documented, then it could well be that the supply of hair loss treatment could be an exempt medical or healthcare supply. But supplying things like Botox, unless you're referred by a medical practitioner for mental health reasons, that's not going to cut it. That's going to be standard rated. And I've got a friend of mine, he's not a client, he's a friend of mine who's an accountant, a partner in a practice. And he had a client who operated a Botox store within a store. And they insisted they supplied exempt healthcare. And I told him many years ago they were supplying standard rated cosmetic surgery. And he told them that they wouldn't change. So he dropped them as a client. He got rid of them as a client. I think he would probably have to make a money laundering report as well, perhaps. Sorry, a question that's come in, Madame. What about unjust enrichment if they receive the VAT refund due to the error? So yeah, unjust enrichment is a very important concept in VAT law, because it could be argued that it wasn't the business that overpaid the VAT, it was the client, it was the customers for the product. So as a general principle, HMRC would only refund the VAT if that refund was passed on to the customers who had overpaid it. However, Madame, there is established case law, and I used this many, many years ago when I used to work at BPP, where HMRC insisted that a home study course should be standard rated, because it included things like tutor support, mock exams being marked, and so on. And we insisted that the books part of it should be zero rated, and only the support should be standard rated. And because HMRC made us charge VAT, this was before I became VAT manager for BPP. I used to lecture for them as well, but I was VAT manager. BPP complied, and they were accounting for VAT. So when I became the VAT manager, as part of my role there as well as teaching, I said, I don't think this is right, and I think we should apply for a refund. And there is precedent case law that says that if you lost out competitively because you were forced to charge VAT when your competitors were not, then you are entitled to keep the VAT refund that's coming your way, because that's compensation for the lost business. So if this business had been incorrectly charging VAT, let's just say that was the case, and their competitors had been zero rating, then their competitors would have probably been cheaper, or the company would have lost margin if it tried to compete on price. And so it wouldn't be unjustly enriched if it got the VAT refund. So your counter argument, Madame, if HMRC raises the issue of unjust enrichment, is that your client lost out competitively by having to charge VAT. Then they should be able to keep the refund. There is, by the way, no such concept as HMRC being unjustly enriched. That concept just doesn't exist. People have tried it in court. It doesn't exist. So if you paid over VAT in error, you can't argue unjust enrichment of the government as a result. Okay, so healthcare has come up in many, many different cases. And usually HMRC wins, because usually the cases involve something which is cosmetic, being done to somebody to make them look better, in their opinion. It's not being done for the treatment of a medical condition, which is going to improve their medical health. Okay, listen, we'll stop for our first break at this point. We'll come back in 10 minutes' time and pick it up from there. If you're going to be watching the recording and not the live event, then we pause it during the recording, so during the break, so it will carry on without any interruption. I'll see you in 10 minutes' time. Okay, let's start again, please. We're working our way through recent developments in the world of VAT and other associated topics. We're talking about healthcare. Just an interesting conclusion to a case in this next situation. Whilst HMRC was correct that this lady's services should have been standard rated, because of the way their systems worked, she actually avoided assessment for it. So she would assess someone's condition and provide them with some sort of skincare medication. Typically, however, the patients came to her directly. They weren't referred to her by a medical professional, some sort of GP or psychologist. She said they came to her because they had damage caused by ultraviolet light, too much sun, if you like, sometimes referred to by beauticians because they couldn't carry out treatments that the patient needed. Back in 2017, HMRC wrote to her explaining that from her tax returns, she seemed to have revenue well in excess of the VAT threshold. Why wasn't she VAT registered? She replied that she didn't need to be because she was supplying exempt medical care as a registered general nurse. HMRC disagreed. They compulsorily registered her, I apologise, going back to May 2007, and then issued estimated assessment of her VAT all the way up to February 18. And they issued that assessment in September 18. Now, what she then did was to submit a nil return on the 27th of October 2020. Now, when HMRC raises an estimated assessment and the taxpayer files a return for those periods, it automatically cancels the assessment. That's what happens in HMRC systems. It automatically cancels the assessment. So HMRC, so she just put 0 in every box. HMRC then issued a new assessment in March 21, and she appealed not only her VAT registration, but also the March 21, sorry, I should say assessment, not registration, I apologise, the March 21 assessment. Now, this gives me a chance to talk about time limits for VAT purposes. Time limits HMRC has to issue assessments. First of all, the first tier tribunal said your supplies are standard rated because the focus is on providing cosmetic treatment to make people look better rather than improving their health per se. But the interesting aspect of this case is the fact that HMRC has a strict time limit to issue a VAT assessment, which is the later of 2 years after the relevant VAT period, or 1 year after evidence of the facts which are sufficient to allow the inspector to raise an assessment comes to HMRC's knowledge. Once they know stuff enough to raise an assessment, they've got 12 months to raise that assessment. HMRC had argued that the new assessment was issued in time, but the only new information they'd received from the previous assessment was the taxpayer's nil return. That didn't add any extra information that they didn't already know. The tribunal said that if HMRC's systems cancel the previous assessment by reason of the taxpayer submitting a nil return, then the submission of the nil return, the contents of that, and the extinguishment of the liability could be evidence of facts to justify HMRC raising a new assessment. But in this case, that return contained no information whatsoever. HMRC would still have raised the assessment in the absence of that return, and the amounts would still be the same. So therefore, this nil return was not evidence of facts, new evidence of facts, for the purpose of extending the period for which HMRC could raise an assessment. The tribunal was not given any reason, any legal reason, why HMRC systems cancel the previous assessment when a return submitted. There may be a legal reason for it, but that wasn't provided in evidence by HMRC, and therefore the second assessment they raised, March 21, the previous one having been cancelled, the second assessment was out of time, and therefore no VAT was owed for those previous, 11 years or so. Should have to account for VAT going forwards, but not retrospectively. So I have to say that whenever you receive a notice of inquiry from HMRC for a client, or you receive an assessment from a client, you've got to, sorry, from HMRC for a client, you've got to check whether it's valid or not. Okay, moving on. Partial exemption, input tax apportionment, I referred to briefly when we talked about private schools. This case involves the Hippodrome Casino in Leicester Square in London, and it operates what it calls a Las Vegas style casino experience, which I think is probably over-egging it, but there we are. It's marketing. Includes a gaming area, obviously. That's where they principally earn their revenue. But it had bars, which they charged for drinks for, restaurants, which they charged for food for, lounges, conference spaces, which they charged fees for, and a theatre. Well, I think more of a cinema than a theatre, but certainly a performance area. The gaming activities produce exempt income, very high exempt income, but hospitality and entertainment are both standard rated. So the company wanted to use a special method override to apportion the overhead VAT relating to the building based on floor area rather than turnover. So if there was an area dedicated to restaurants and bars, that's making standard rate of supply. So the input VAT on that area should be recoverable. The input VAT on the conference spaces, the cinema, similarly, should be recoverable because they're making standard rate of supplies. And only the input VAT that relates to the floor area occupied by the gambling area should be disallowed. They believe that more accurately reflected the economic use of the expenditure. The first tier tribunal had agreed with the company, but HMRC had appealed this to the upper tribunal. And the basis was that the judge, the basis of the appeal was the judge in the first tier tribunal had failed to consider the fact that the floor space had a dual purpose. Now, what does that mean? Well, because a casino makes almost all of its profits from gambling, it subsidizes the bars, it subsidizes the restaurants, it subsidizes the cinema, it subsidizes the conference areas. Why? Because it wants people to stay as long as possible, because that means they might well gamble more, and that's where the real money is made. So the casino, the Hippodrome Casino, does not make profit out of its bars, its restaurants, and its cinema. They are there to attract people into the building or keep them in the building so they gamble more. So HMRC's argument is that those areas are just a means to an end. They're not an end in themselves. There are some people who can go into a casino, have something to drink, have something to eat, and come out again without gambling. Okay? But they are the very small minority. So the upper tribunal, in allowing HMRC's appeal, did say, well, the judge made an error of law, because whilst he rejected HMRC's arguments that hospitality and entertaining floor space had a dual purpose, the judge didn't say why he had rejected, didn't give reasons for it. And the upper tribunal judges, there's two of them, ruled therefore that the standard method override, which the company had proposed, didn't guarantee a more precise calculation, and it has to. The special method override, if you apply for a special method, you have to demonstrate that it produces a more reasonable result than the standard approach. Because the hospitality and entertainment areas were also used economically for gambling, because they kept people in the building, didn't make a profit on their own, the focus was on people to spend more at the gambling tables and machines. Those floor areas played a role in the gambling income as well as the entertainment income. So it wasn't fair, certainly not fairer, to base input VAT recovery on floor space. So if you want to use a special method, you have to apply for it, and HMRC has to approve it. If they don't approve it, we might end up in the same situation as the casino, having to go to tribunal to prove that we have a fairer method. Sometimes you win, but as in this case, sometimes HMRC's argument is just a stronger argument. This is, in my mind, there's no doubt this is the correct outcome. That these other areas are means to an end, they're not an end in themselves. The next case, somebody talked about VAT grouping a bit earlier. I can't remember exactly who, but somebody commented about VAT grouping. This is a very interesting case about companies that were part of a VAT group, but then later left the group. So this is yet to be heard because it's been further appealed to the Supreme Court, but the latest decision we have is from the Court of Appeal. It involves Prudential. Prudential is a financial services company, so the vast majority of its supplies are exempt, so it cannot recover much input VAT. And it used to have a group company called Silverfleet Capital, which provided investment management services to the group. While it was part of the group, it was VAT grouped, and therefore its services were outside the scope of VAT for that period. But like a lot of investment managers, it would be entitled to an extra amount of consideration if the investment advice that it gave produced returns above a certain benchmark. So it put these investments in place. It left the group. Those investments performed better than the benchmark, and so now the company is entitled to an extra fee. Since it left the group, it hasn't provided any further investment advice to the group. They've got other advisors who now do that. So the issue to decide is when it gets that extra fee, does it account for output VAT? Does it have to charge output VAT to Prudential, which Prudential really can't recover because it's an insurance stroke financial services business? Because at the time it's receiving that fee, it's not part of the VAT group. Or do we say that the fee is in connection with the services it did provide when it was part of the VAT group, and therefore should follow the same VAT treatment as those supplies outside the scope? So Prudential obviously believed that the fee should have no VAT on it because they wouldn't be able to recover the VAT charged. HMRC argued this was a situation where there was a supply of continuous services and the VAT was chargeable because the related invoice and payment had occurred after Silverfleet had left the group. So with continuous services, and you will sometimes provide continuous services to your clients, you're always standing ready to give them more advice or do more work for them. So you're providing continuous services. Normally a tax point arises when either they pay you or more likely you invoice them first. But until you invoice them or they pay you, no VAT is chargeable. So the first tier tribunal had found in favour of Prudential that no VAT should be charged. The upper tribunal had reversed that decision, and so Prudential appealed to the Court of Appeal. And the Court of Appeal's decision was that we approach this by identifying when the supply was made using the time of supply rules, the tax point rules. Then consider whether the companies were still members of the same group at that time. The Court of Appeal has said that in its opinion, this is a continuous supply of services, and therefore the tax point is the earlier of invoice date or payment date. And when the invoice was raised before payment was made, Silverfleet was no longer part of the group and VAT should be charged. And so the group's appeal was dismissed. With respect to the upper tribunal and the Court of Appeal, I disagree. I think, as a matter of fact, Silverfleet stopped providing services to the group when it left the group. It had put the investments in place. It had charged a fee for that with a contingent extra amount payable should they perform well. But Silverfleet didn't supply any other services once it left the group. So how can this be a continuous supply of services? And therefore, I think it should be referable back to when the original supplies were made, and I think it shouldn't have VAT charged on it. But we'll have to wait and see what the Supreme Court says. It's actually a really important point of law because this happens quite a lot. You may never come across it. I have come across it, and we are waiting for this appeal to be finally determined before we can settle or not with HMRC. So you may well see this at some point in the future. So we need a Supreme Court decision to really hammer down what the correct answer, what the legally correct answer is. Because whatever the Supreme Court says, that's the law. It can't be appealed any further. Personally, I think it's been wrongly decided, but as this is a Court of Appeal decision, it is currently binding until another court overturns it. So HMRC will be within their rights to raise assessments for similar cases. And I think taxpayers will be within their rights to ask HMRC to postpone the tax, make a protective appeal, pending the outcome of the Supreme Court decision. Because I don't think that that is a continuous supply of services. And I think that's the error of law which the upper tribunal and the Court of Appeal have made. But we'll see whether I'm right in the fullness of time. I talked about mega marshmallows earlier, so I'm not going to go through that case again now, but it's just yet another situation where a new product does cause VAT issues. This is yet another one, blissful biscuits. Take a look at the picture at the top right of the screen. Don't focus too much on the main picture because the actual biscuit looks like the one that's lying down to the right of it. What you can see is it consists of a biscuit base. There is chocolate inside that base. But if you look carefully, the chocolate seems to be slightly above the rim of the base. And then there is a biscuit covering, but it doesn't cover the entire circumference of the biscuit. You can see that around the outside here, there are bits of chocolate. Okay. In reality, this is closed up in the middle here. That's all closed up. But round the outside, you can still see bits of chocolate. Why is that important? Because the VAT law, bless it, says that any biscuit which is partly or wholly covered in chocolate is standard rated. Any biscuit by inference which is merely filled with chocolate is not covered by that rule and therefore is zero rated. So the question is whether this biscuit was covered in chocolate, partly or wholly, or whether that is a chocolate filling. McVitie's, who produced this, said it was a chocolate filling. HMRC said, to some extent, it is covered in chocolate. So we talked about the case itself. The first tier tribunal decided that to be standard rated, it must be wholly or partly covered in chocolate. And the term partly takes on its ordinary English meaning, which means to some extent. Not to any great extent, but to some extent. So the question is, what covered the remaining area of the product that wasn't covered by the biscuit lid, the bit that sits on top of the base? And the judge said that the ordinary person in the street said that the biscuit was covered by the logo biscuit lid, but in part covered by a layer of chocolate. And therefore, the ruling is that this biscuit is standard rated. McVitie's had treated it as being zero rated. They now owe 1/6 of their revenue from that biscuit as output VAT. Because to some extent, it was covered in chocolate. Now, McVitie's must have a VAT team because they must have this issue a lot when they produce new products. They must know the VAT law, and they must have realised there was a risk that HMRC would say that this was covered in chocolate because that top didn't cover the whole thing. If you go back to the picture, if you had that logo biscuit and it just covered the whole circumference of the base, don't worry about the bits in the middle here because they don't stick out of those bits. Yeah. If that biscuit had covered the whole of the circumference, that biscuit would have been zero rated. So for a little bit more biscuit around the edge, the company would have saved 1/6 of its revenue going to HMRC as output VAT. And I always say to people, if you ever make any subtle change whatsoever in what you produce, what you sell, who you sell it to, or how you sell it, it can make an absolutely massive difference to the VAT outcome. So whenever a client changes what they're doing in some shape or form, changes customers, changes suppliers, changes what they sell, changes how they sell it, changes what services they supply, changes their customer base, they've got to check the VAT status after that change and just not assume it's the same as before. Okay, onwards. I'm going to skip over sensations. Poppadoms. This was Walker's saying that the poppadoms they sell in crisp packets should be treated as zero rated, because poppadoms you buy to have with generally your Indian food, they are zero rated. Well, yeah, they are zero rated because they're made with something called gram flour, and this is made with potato flour. And any item made with the potato is specific. Any snack made with a potato is specifically standard rated. They stood no chance of winning whatsoever. But I'll skip over that one. That's enough, I think, food and drink for now. This next case deals with whether the narrative on an invoice is adequate or not, because you can only recover input VAT if you hold a valid VAT invoice. And the regulations say that that has to include a description which is sufficient to identify what was supplied. So in this case, it's a construction company looking to recover input VAT on some invoice. Oh, beg your pardon. Carolyn, thank you. Full biscuits. How would the ruling affect the shops that sell the product? Yeah, they would have to charge VAT on their customers. McVitie's will sell the biscuits to wholesalers. Wholesalers will sell it to shops, and shops will sell it to customers. Every supply in that chain will now be standard rated. So I suppose McVitie's might be able to raise a VAT-only invoice to the wholesalers that buy their biscuits, because those wholesalers would be able to recover that VAT because they'd make an onward supply to the retailers, the grocers, for example, the supermarkets. They would be able to recover the VAT. But when they sell it to the end consumers, you and I, we can't recover the VAT. So what they're going to do, they're going to increase the price by 20%. Then maybe nobody would buy them. They do look delicious, by the way, but maybe nobody would buy them for 20% more than they're charging. So somewhere along the line, there has to be an absorption of the VAT. So I imagine that the supermarkets will say, the grocers will say, we can't charge more for this. The price includes VAT. We want a cheaper price from our suppliers. And they'll say, we want a cheaper price from our suppliers. So at the end, I think McVitie's has to reduce the price it sells the product to the wholesalers at. So I think ultimately McVitie's loses out. But you're quite right to point out that VAT gets passed along the chain now that these are standard. They're standard rated for everybody. For everybody who sells them, they're standard rated. Wholesalers, manufacturers, retailers, the whole lot. Okay, so back to our adequate invoice narrative. In this case, the 3 invoices disputed by HMRC contained a description which said building works at the above. And it provided a box above, which was the job address. Okay, so the address of where the work was being carried out. It did state that VAT was being charged at the standard rate. It included a VAT exclusive subtotal, the VAT amount, and the overall total. So broadly speaking, the VAT invoice was fine, but HMRC said it didn't meet the requirements in the regulations because the description wasn't sufficient to identify the goods or services supplied. Well, I think it is. Building works. They argued that for each description, because the regulations say it, the quantity of the goods or the extent of the services and the rate of VAT needs to be included. And they said that it wasn't possible to ascertain from this narrative whether those works should be standard rated or not. Because if they're working on building new homes or a new care home, then it will be zero rated. If they're doing a qualifying renovation, then or a qualifying conversion, then the supply would be 5% rated. And if they're doing work on a commercial building, building a commercial building or extending any building, it would be standard rated. And so HMRC's argument is that description doesn't tell us the correct rate of VAT, so it's not good enough. The company appealed against the refusal to allow the input tax recovery. And the judge in first tier tribunal says the reason why you have to include a description on the invoice under the regulations is, first of all, to enable both the recipient and the supplier to have a common understanding of what was supplied and what this invoice actually. Secondly, to provide HMRC, should it want to inspect the records, with a means of understanding the essential nature of the supply, and then a means to then identify correspondence with the recipient or the supplier if they want to seek some more information about what was supplied. And they said, look, HMRC has these huge information powers. And if they received information and that held that the wrong rate of VAT was charged, they could refuse the VAT recovery. So it was up to HMRC to ask more questions. The invoice did its job. It essentially described what was supplied, building works at a certain address. So both the supplier and the customer knew what this related to. If HMRC wants to find out more information about it, ask. The invoice doesn't have to be a work of several paragraphs, just so that HMRC is happy that the supply is definitely 5% rated, 0 rated, or standard rated. So the judge decided this description was adequate, and HMRC would understand the nature of what was supplied. So the input VAT was recoverable. However, I have seen other invoices which simply say services rendered. And that is nowhere near enough. And any business trying to recover VAT on an invoice that merely says services rendered may find that HMRC can attack that quite easily. If it says services rendered per our spreadsheet supplied, that's fine. Because then HMRC can ask to see the spreadsheet and that will explain what services were supplied. So I keep a spreadsheet of queries I answer for one particular client every month and send them one invoice at the end of the month saying, here's the total of all the consultancy services I provided per the attached spreadsheet. And I always send the spreadsheet with it. That's absolutely fine. Okay. But services rendered, not good enough. Even management services is a bit risky. It really needs to identify what type of services were supplied in that kind of situation. Next important case, Hotel Latour, really important case. Got as far as the Court of Appeal, may end up at the Supreme Court, by the way, yet. It's a case which, when the first tier tribunal and upper tribunal gave their decisions, I thought was wrong, instantly thought it was wrong. And the Court of Appeal has overturned those decisions. It's around a situation where a company owns hotels, but it's companies. So each hotel is held in a separate company, and it wants to sell one hotel and build another. So it wants to sell a hotel in Birmingham and build a hotel in Milton Keynes for whatever reason. So to sell the hotel, it's going to sell the shares in the subsidiary. In order to make the sale, the hotel group incurred marketing, legal and accounting fees totaling some 383 grand, on which VAT of some 76,800 was charged. And when the company filed its September 17 VAT return, it tried to recover the input VAT on those legal fees. HMRC opened inquiries and later concluded that, in its opinion, the input VAT wasn't recoverable. Why not? Because it relates to an exempt sale of shares. The sale of shares is an exempt supply. The hotel group said, no, the sale of the shares is a means to an end. We're only selling the shares to raise money so we can build a hotel. It will make taxable supplies of accommodation, so we should be able to recover the input VAT. Both the first tier tribunal and the upper tribunal found in the hotel's favour that the exempt share sale didn't break a direct and immediate link with the taxable Milton Keynes hotel activity, and therefore found the VAT was recoverable. And I told my clients, when both those decisions were announced, if you're recovering VAT in a similar situation, don't spend it. Keep it to one side, because you may well need to pay it back to HMRC. So when it went to the Court of Appeal, the Court of Appeal says, yeah, the correct test is there a direct and immediate link between the input and the output? But when you're doing that, in this case, the first question you ask is, was there a direct and immediate link between the professional services incurred and the exempt share sale? And if your answer to that question is yes, you stop. You stop, that's it. And so in that case, the fees are not recoverable. The VAT's not recoverable. If there wasn't a direct and immediate link between the professional fees and the share sale, then you'd look at the downstream supply, the hotel construction. The first tier tribunal had already found, as a matter of fact, that the fees were incurred as part of the selling of the shares, so they must have been directly linked with the exempt share sale. So they should have stopped at that point and said the VAT was not recoverable. The group then had some other argument that because it's a VAT group, although the parent company supplies management services to each hotel, those should be totally disregarded because they're disregarded for VAT purposes. No VAT is charged. Therefore, it should be seen that Hotel Latour Limited, the holding company, didn't have any economic activity whatsoever. So all of its input VAT should be treated as being residual, and under residual would be recoverable. The Court of Appeal said, no, that's rubbish. Didn't use those words, but said effectively that's rubbish. Just because we disregard intra-group services and goods transferred for VAT purposes doesn't mean they don't take place. They do take place. So there is economic activity in the parent company. It is billing for management services. It's just not charging VAT on those services. Therefore, that argument failed as well. Now, onwards. This next case, I don't know why these cases still come to court, because this principle was established donkeys years ago. If your client charges an extra price, an extra fee, for things like card processing or a booking fee or something similar, then that just forms part of the price of the thing they're selling, and it follows the same VAT treatment as that thing. Just because you describe something on an invoice as a credit card processing fee or a credit card merchant fee when you're raising a sales invoice doesn't mean that you're providing an exempt financial service to your clients. You are not. Okay? The merchant is. And the merchant will charge the supplier a fee for processing the card and getting money into their bank account. And all the supplier is doing is adding that fee to their price that they're charging their customers so that they can maintain their margins. That's all. This next case, again, just reinforces the idea that if you do something in a slightly different way, it could have dramatically different VAT implications. So this is the case of Derby Quad Limited. It's a theatre company. It usually just puts on live plays in a theatre. Customers come, they pay an entry price, and that price is exempt under what's called the cultural services exemption. Just like if you go to the opera, if you go to the Royal Opera House, your ticket price is exempt from VAT. As long as you're a non-profit making body, qualifying body, you can exempt your fees. But what this company did was, as well as putting on the live performance in the local theatre, it gave a live broadcast, a live stream broadcast to punters who were sitting in other theatres who were watching it on a screen, as if they were watching a TV programme. And Derby Quad Limited thought that those ticket sales should also be exempt from VAT, but that is not correct. Because although it's a similar thing, it's not the same. Putting on a live theatre event is not the same as being, as watching it on a screen in another theatre, because the actors cannot hear the audience and cannot interact with the audience in a two-way interaction. So what the company was selling to the punters watching the live stream was not the same as what they were selling to the punters who were watching the live performance in the theatre. The second one was exempt, but the first one was standard rated. And having charged a fixed ticket price, Derby Quad Limited now owes 1/6 of the ticket price of those people watching the live stream as output VAT. Okay, doing something in a slightly different way can dramatically change the VAT treatment. The next case is just a simple, I think it's a simple idea of don't disturb the hornet's nest, because it could lead to worse trouble along the way. So this company offered advice to individuals aged 55 plus in two areas. First of all, equity release mortgages. Well, they are, if you offer an equity release mortgage and you charge a fee for doing so, that's an exempt financial service. But also estate planning. Well, estate planning is professional advice and therefore is standard rated. As it was a partially exempt trader, it was using the standard method to recover its residual input VAT, and about 90% of its business was equity release, or its turnover was equity release, and about 10% was estate planning. The group then instructed KPMG to see whether they might be able to use a special method in an effort to recover more input VAT. KPMG submitted a proposal called the transactional account method. HMRC rejected it on the basis that it was no fairer than the standard method. A year later, the company then proposed an income adjusted method, which was based on KPMG's method, but a bit different. That was also rejected. But the company went ahead anyway and submitted 4 error correction notices claiming more input VAT under their special method, which hasn't been approved. Unsurprisingly, HMRC rejected that. And then, having poked the nest, HMRC decided it would review the group's marketing expenditure and reached the conclusion that none of the input VAT on its marketing should be recoverable, on the basis that all of the marketing related to equity release mortgages and none of it related to estate planning. So it should be directly attributed to the exempt activities. It wasn't residual input VAT. Prior to them poking the nest, HMRC had never raised any queries about recovering 10% of the VAT. The group appealed all of this stuff. The tribunal agreed with HMRC's view on the marketing expenditure, because HMRC reviewed the marketing and the marketing only made reference to equity release. It made no reference whatsoever to estate planning. The wording was how to stay in your home for longer and not having to downsize. If it was going to offer estate planning advice, that would come and it would only be provided to people who took an equity release mortgage. The group never provided standalone estate planning advice. You only could get it if you'd taken out an equity release mortgage and you wanted it. And therefore, the advertising focus was 100% on the mortgages. So there was no direct and immediate link to estate planning. And so none of the input VAT on the marketing was recoverable. So having lost their case to use a special method, they've now lost 10% of the VAT that they were recovering on their marketing expenditure. I mean, quite rightly, by the way, this is a correct decision. But by poking the hornet's nest, HMRC takes a closer look and everybody but everybody makes VAT mistakes. Nobody gets VAT 100% correct. Not in a decent sized business. And once HMRC starts looking, they're going to find stuff. This next case, I also find very helpful in terms of the principles that it produces. So it involves Simple Energy. You might know them better as Bulb Energy. The case itself involves Bulb. They supply energy to both UK businesses and homes. And when a new customer joined Bulb, the company provides them with an electronic referral link, refer a friend. If, having used the link, the friend switches to use Bulb, both the customer that gave them the referral link and the friend get a credit against their energy account. The question is whether that credit includes VAT or not. Because if the credit includes VAT, then that VAT can be recovered from HMRC. When you sell, you pay VAT to HMRC. When you credit the customer, you recover VAT from them. So the question is whether the referral fee received by the existing customer was for the provision of a service that customer made to Bulb, which means that the credit constituted non-monetary consideration for the supply of energy, or was it a discount that just simply reduced the value of the energy supplied by Bulb? So just to get this in focus, let's say that I'm Bulb and you are the customer who has referred a friend. And they've taken a contract out, so you're now getting paid some money. Your account's now being credited. So the question is, from my perspective, Bulb, did you provide me with a service which I'm now paying you for? Because if so, you're not VAT registered, you're just an individual, and therefore that has no VAT on it, and the full credit is applied to the account. And I can't recover any input VAT. Or am I crediting the value of the energy you're buying from me, in which case it's a standard credit note, and I can recover the VAT element of it as the business? You can't, but I can. So the court said that the referring customer had to do something to get their credit. They had to provide a service to Bulb by trying to encourage somebody else to take up a contract. So you are providing a selling service, a marketing service to me. So I'm paying you for a marketing service. So I can't, when I credit your accounts, essentially it's as if you were raising a sales invoice on me and I'm crediting your account to pay it. So there's no VAT at all in that amount. But the new customer gets a credit just for signing a contract, literally just for signing a contract. So what they're doing is getting an advance credit on account of the energy they will buy from me going forwards. And therefore, they didn't provide me with any specific service to be paid. So I'm just giving them a discount on their future energy consumption, so I can recover the input VAT on the credit note. So I gave you a referral link, you gave it to somebody else, they click the link, you both get paid, or both get a credit, both get a 50 quid credit. Yours has no VAT, your friend's does. And that's why we have to always think very carefully about the nature of what is being supplied by whom to get the right VAT decision. Okay, that's recent developments in VAT. As Marie said earlier, it's been a couple of years since we had a VAT update, so there's a few things to catch up with there. We're going to spend the remainder of our time looking at 2 or 3 different areas just to remind you of some of the key principles. Let's make a start on land and buildings, and we'll take a break around about 11 o'clock. So, generally speaking, VAT applies for land and buildings to the grant of any right or the grant of any interest over land. And for VAT purposes, a license to occupy land is essentially the same as a lease, has the same VAT treatment. There's no distinction. Now, HMRC sometimes try to argue that if somebody has an option to buy land or an option to sell land, but they don't actually own the land, that if they buy or sell that option, that is not a land-related supply. It obviously is, because an option is a right over land. You may not exercise the right, but it's a right over land. So they always try to argue that if I hold an option to buy land, because I don't own the land, when I sell that option, that's not a land-related transaction. It's a general transaction that has standard rated VAT. That's rubbish. Okay. As we'll find out very shortly, the default rule for land-related transactions is that they are exempt from VAT unless the legislation tells us something different. About every 4 or 5 years, they bring a case to court, they lose it, they go away again. 5 years later, they forget they brought it and they bring it again and they lose again. It's almost a 5-year cycle since I can remember. Now, as I mentioned, the golden rule, well, I'd say this is the platinum rule. The platinum rule is that unless stated otherwise, property transactions are exempt supplies. If the legislation says different, we do different, but if it doesn't, they're exempt. And that's different to every other supply for VAT purposes. In every other case, the default is that a supply is standard rated unless it's explicitly stated to be exempt, 0 rated, or 5% rated. So it works very differently. Now, To narrow things down somewhat, broadly speaking, supplies of land, bare land, and commercial property can only be standard rated or exempted. That's it. Two choices: standard rated or exempted. And broadly, the supply of residential property, including things like care homes, can only be zero rated or exempt. But in connection with residential properties, including care homes, the purchase of goods and services related to those properties can be standard rated. I'm talking about supplies of the properties themselves. We can narrow it down somewhat. So when you're trying to establish the correct VAT rate, read the law. Read the law. First thing to read, Schedule 8, Group 5. Schedule 8, Group 5, 0 rating. That can only apply, as I mentioned before, if the supply relates to dwellings, homes, residential purpose buildings like care homes, and charitable use buildings. And it only applies specifically for services rendered on the construction of one of those buildings. So that's the supply of builders, plumbers, electricians when you're building a new one. Or it also covers, zero rating covers, the first grant of a major interest by the person who had the property constructed. So a major interest is the first sale of a freehold in the building, or the Scottish equivalent, or the grant of a lease for more than 21 years. But if you're in Scotland, it's more than 20 years. Okay? If the property is in Scotland, it's more than 20 years. That is it. So a developer who, for example, is building houses to sell, they're expecting to make a zero-rated supply when they've finished. So they can recover any input VAT they incur. They're not going to incur input VAT on the construction costs. They're zero-rated. But they will incur VAT on things like professional fees, legal fees, architects' fees, surveyors' fees, project management fees. They can recover that VAT. If, when the houses are completed, the market has dropped, as it has done at the moment, and they don't want to sell the properties at the price they can get now, they might decide to rent out the property for 3-4 years, waiting for the market to recover. Charging rent on a house is always, always, always exempt supply. But let's say that 4 years later, the lease finishes and they now can sell the house because the market has picked up. The 4-year lease they granted initially is a minor interest. It's not more than 21 years. So when they sell the freehold, it is the first sale of the freehold in that property by the person who had it built. And therefore, the sale of the house 4 years later is zero rated. And if they rented it again after 4 years, for another 4 years, and 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 another 4 years, so that 24 years later, the market finally picks up, and they sell the property 24 years later, they've previously granted 6 4-year leases. They are all minor interests. When they sell the freehold, it's the first time a major interest has been granted since that property was finished. So 24 years later, the developer sells the property, it's a zero-rated supply. If it's not zero-rated, you can check whether it's reduced-rated, Schedule 7A of the VAT Act. And that's only if it's a qualifying conversion or a qualifying renovation. We'll look at those briefly in a bit more detail shortly. If it's not 5% rated, then check whether it is explicitly standard rated by the law. The sale of a commercial building, which is part finished, or it's within 3 years of being finished, is always, always, always standard rated, no matter how many sales take place until that 3-year deadline. They're all standard rated. So are transactions involving land and commercial buildings, where the supplier has opted to tax their interest in the building, okay, in their building. The supply by a builder of repair services, renovation services, extension services, conversion services for any land and buildings are standard rated if they haven't been covered by a special rule above. And everything else is exempt, including the sale of bare land, where there's no option to tax made by the vendor, charging rent, where there's no option to tax made by the vendor when it comes to commercial property or land, the second or subsequent sales of major interests in dwellings, care homes, charitable buildings, etc., exempt. And the sale of a commercial building more than 3 years after it's finished by default is exempt and can only be modified by a option to tax. I've got a couple of questions that have come in the chat, and I'll address them after we've had our second break. So let's just stop for 10 minutes and we'll pick things up from there. I will answer your questions, I promise, when we come back. Certainly the first one. The second one's a client-specific one. I'll have a read and see what I think. Start again, please. Welcome back to our third session. We had 3 things come in on the Q&A and 1 come in on the chat. Anthony, thank you. How is the input tax on residential construction affected if the lease for 4 years for sale? I'm going to answer that with one of the slides very shortly. So please just, if you can hold the excitement for another few minutes, I'll get to that. Chetan, a client who's converting commercial unit into mixed use. So a current commercial unit has 4 floors, which are office only. They intend to convert the top 2 floors into duplex residential, the bottom 2 floors into converted or commercial spaces, etc. With the top floor conversion to residential qualify as a new build. Well, first of all, Chetan, we're going to see that in the slides. As far as the residential parts are concerned, that's a qualifying conversion of the building. So the actual inputs, the actual building work to do the conversion, 5% rated. But yes, they've created dwellings that weren't there before. So they are new dwellings. So when they're sold, they will be 0 rated. Dev, the VAT position on a new commercial building held at the end of the 3rd year and sold subsequently. For clarification, can the developer recover input VAT, but is the sale exempt? So if the new commercial property is sold within 3 years of being completed, it's a standard rated sale. So of course, input VAT can be recovered. If it's sold just after 3 years from completion, and the vendor doesn't opt to tax their interest in the building, the sale will be exempt. So the input tax on the construction costs will be irrecoverable. So they would need to opt to tax before they sold the building in order to charge VAT on the sale, because it's a commercial building, they can do that, to recover the input VAT. And the question in the chat, if a commercial building is you can see the chat actually, but if a commercial building is purchased that is opted to tax, but the intention is to renovate and convert the building into a residential property, can a 21-year lease be granted to a subsidiary or third party, enabling the input VAT to be reclaimed? Not entirely sure what that is getting at. They've paid VAT when they bought the building. If they're going to renovate it and convert it into residential property, they'll be charged 5% VAT to do the renovation and the conversion. If they're then going to rent out the, I suppose, apartments once the building is finished, yeah, that would be an exempt supply. So yeah, what they should do in that case is they should buy it through a development company, register the development company for VAT, recover the input VAT that they're charged on the purchase and on the renovation costs, the conversion costs. And then, yeah, they can then create a 75% minimum group company, but probably 100% group company, which becomes the investment company. And then when the development has been completed, the development company can grant well, it's got to be more than 21 years. Be careful, Sean, more than 21 years. So grant a 22-year lease, unless you're in Scotland, in which case you can grant the 21 years, it's fine. But grant a 22-year lease to the investment company, and that is a 0 rated supply. And the investment company doesn't therefore pay VAT, and they can rent out the property as an exempt supply without worrying about input tax recovery because they weren't charged VAT in the first place. That is fairly standard VAT planning. Yeah, and there's nothing remotely wrong with that approach. It's not considered to be tax avoidance in any way, because HMRC, or the government actually, wants to encourage the building of residential accommodation. They want to therefore encourage by allowing the recovery of input VAT wherever possible. So, Sean, I hope that answers your question correctly. Yeah, I think that pretty much answers your question correctly. If they use a development company, investment company group, then they can recover all the input VAT, make a zero-rated supply of a 22-year lease to the investment company, and then the investment company can rent out the property. But it's got to be more than 21 years, not 21 exactly. That wouldn't do it. That would be an exempt supply. That would blow the whole thing. The two companies should not be in the same VAT group because it needs to be a taxable supply when it's made. And bear in mind that that will be exempt from stamp duty, SDLT, unless the investment company is sold within 3 years. If the investment company leaves the group within 3 years, then a retrospective SDLT degrouping charge can arise in that situation. Cool, very good. That's covered some of the slides I was going to cover anyway going forwards, so I will skip over those where necessary. Okay, we'll leave this bit alone. Zero rating. Schedule 8 Group 5 of the VAT Act actually says that the following are zero rated. The supply in the course of construction, so until the property is completed, a building designed as a dwelling or number of dwellings, or it's intended for use for a relevant residential purpose, like a care home, or it's intended for use for a relevant residential purpose. Civil engineering works to do with caravans, skip over that. And the specific zero rating is supply in the course of construction of any services related to the construction. That's the phrase, related to the construction, but not the services of an architect, surveyor, consultant, or supervisor, like a project manager, for example. They are standard rated. And if the builder also supplies materials as part of the service, then the materials are covered by the zero rating as well. But not all supplies by a contractor in building a new house are zero rated. The supply of goods which are not ordinarily installed in new dwellings is not zero rated. So things like carpets, fitted wardrobes, standalone electrical appliances, things like standalone washing machines, tumble dryers, TV, entertainment systems, that sort of thing. Now, if the contractor is invoicing the developer of the property, they would have to charge standard rated VAT on those goods. Surprisingly, not the installation of the goods, just the goods themselves. If they charge an installation service, that's actually covered by the zero rating. If the developer is charging the intended homeowner, the first person to buy the complete property, then the developer always zero rates the entire supply. If you buy a new home, even if it's fully furnished, you don't pay any VAT. The way that HMRC gets their money is that the developer selling that property to you without charging VAT cannot recover the input VAT on these goods that they've paid for, which are not normally installed in new dwellings. And what's installed in new dwellings does change, does evolve over time. So, for example, a few years ago, blinds, window blinds came on the list. As long as they're manual blinds, not electric blinds, but manual blinds, because they're becoming far more popular these days than curtains. Curtains are still on the list, but blinds have also made it on the list. That, by the way, is often referred to as the builder's block. Colloquially, it's actually a developer's block. It's the developer that can't recover the VAT, not the builder, because the builder charges VAT to the developer, so they can recover the input VAT when they buy the stuff in the first place. Developers letting rather than selling. We talked about this before break, and somebody asked a question about the input VAT recovery. So in that situation, I mentioned that the supply, when they sell eventually, is the first grant of a major interest, but they might not be able to recover all the input VAT because they have made exempt supplies with the building. and they have incurred VAT on constructing the building, on professional fees principally. So therefore, what we do is use a combination of partial exemption principles and something called the capital goods scheme, which says that we should judge input VAT recovery on a building over a 10-year period to work out whether we need to pay back any VAT. Because if I'm a developer just finished building some houses and I rent them out for a short time before selling them, I've made some exempt supplies followed by a zero rated supply. So I'm partially exempt, but I'm kind of partially exempt over a number of years. It's not your traditional partial exemption. So just to show you how it works, a couple of examples. Let's say that a client is a small time developer and they construct one house each VAT year. And they built this particular one and it won't sell in the open market. My apologies. So they've decided to rent the property till the market picks up, and they've so far recovered input VAT on materials they bought directly for the house and architect's fees of 22 grand. They intend to rent for 3 years and then sell. And the key here, you work out the VAT implications at the date they change their intention. They were going to sell, they're now going to rent before they sell. That is when you carry out these calculations. So they intend to rent for 3 years and then sell later. Do they have to pay back any of the VAT because they're going to be making exempt supplies of rent? Well, we use the capital goods scheme to say that if we're judging input VAT recovery over a 10-year period, and they're going to rent out the property for the first 3 of those 10 years, then 3/10 of the input VAT relates to the rental. 3/10 of it relates to the exempt supply. That's £6,600 in this case. That is de minimis because it's under 7.5 grand in the VAT year, and it's less than half of the total VAT they've incurred. It's less than half of 22 grand. Of course it is, it's 3/10. 3/10 is less than a half. And therefore, they don't have to pay back any input VAT that relates to the exempt rental because it's de minimis under partial exemption rules. But if it's bigger, we have to work out a payback. So let's say that we got a rather larger developer who during the year develops 2 houses which have a market price, an expected market price of £500,000 each. They recovered input VAT related to the construction of 50 grand during the VAT year. But again, the market's dropped, they want to rent out the properties, and they estimate that over the rental period, they'll generate a gross amount of 200 grand in rental income. That is combined for both properties. That's 100 grand, if you like, for each property. And again, it's a 3-year initial rental because they believe they're better sell after 3 years. So if we take the same 3/10 fraction we took before of the input VAT, because for the 10 years we judge the input tax recovery, they're making exempt rentals for 3 of those years, that comes to 15 grand. That's not de minimis. It's above 7.5 grand a year. So therefore, there is going to be a payback to HMRC of some of the input VAT. How do you work it out? Using the standard approach to partial exemption. The only difference here is that because we make the calculation at the date the intention changes, it's based on forecasted rent versus forecasted selling price of the houses. Because the selling prices are the zero rated supplies and the rentals are the exempt supplies. As long as your projections are reasonable, you don't go back and recalculate it later. It's a one-off calculation. Well, they're expecting exempt income of 200 grand. At the end of 2 years, or 3 years, sorry, they're expecting to sell the houses for 500 grand each. That's £1 million. And so the clawback is the ratio of exempt supplies to total supplies multiplied by the input VAT they've previously recovered. So they're going to have to pay back £8,334 to HMRC of the input VAT. That's their partial exemption adjustment as a one-off adjustment. Even if they don't sell the properties after 3 years, because the market didn't pick up, and they end up renting them again for another 3 years, as long as it was reasonable to suppose they could sell them after 3 years, as long as that was a reasonable assumption, there's no further amendment to the calculations. That's it. HMRC can only force an adjustment if they could demonstrate that the taxpayer had been unreasonable in the figures they had used in their calculations. So I hope that answers the question about the input VAT recovery. The next slide just talks about building dwellings to rent out, and it picks up on the example that's in the chat about granting 21-year leases. So the idea of using a development company, if you know you're going to rent out the properties and their dwellings, they're going to be exempt suppliers. But you can still recover any input VAT incurred by using a development company, investment company approach. So when the development's finished, grant a more than 21-year lease to the investment company. That's zero rated, so the VAT can be retained. The investment company hasn't paid any VAT, so there's nothing to worry about there. There's no SDLT because it's a 75% group transfer, but there might be some corporation tax to pay because the development company has granted a lease to the investment company, and granting a lease can have tax implications, direct tax implications, but hopefully not too much. But we have to do a calculation of how much corporation tax development co will pay, because if the corporation tax is as much as or more than the input tax recovery, it ain't worth doing it. Yeah, it's just not worth the hassle of doing it. So it would be a cost-benefit analysis. Misconceptions around the option to tax. I had a VAT query only this week. In fact, I think it was on Wednesday evening. Somebody messaged me asking me for some advice and had made a big misconception about how the option to tax works. So a person makes an option to tax over their interest in the land or building. There's no such thing as a building having an option to tax over it. A building cannot submit an option to tax form because it hasn't got any hands to write out the form. Only a person can do that. And so all they're doing is opting to tax their interest in that building. That doesn't bind anybody else. Just because I opt to tax a particular building doesn't mean that if you have an interest in it, you have to opt to tax it. You make your own mind up. These are personal things. Okay, these are personal things. And it's a two-stage process. First of all, you have to make a conscious decision you wish to opt to tax the property, a deliberate decision. And then you have to notify HMRC. These days, you notify them by emailing the form, form 1614A. You email it to a particular email address, which is option to tax national unit, all one word, at hmrc.gov.uk. They don't check the form. They just reply with an auto out-of-office reply saying, we got your email. And that is the proof you notified. But it doesn't mean that the option form was valid. And if the option form wasn't validly completed, you haven't actually opted. And that could create problems further down the line. So double check and triple check that the form has been correctly completed and signed by whoever needs to sign it. Now, strictly, you're supposed to notify HMRC within 30 days of your epiphany that you wish to opt to tax. But if you're a bit late doing it, it's not a problem. However, if you don't notify HMRC and then you dispose of your interest in that land and you still didn't notify them, the option doesn't exist. The option never happened. And that can cause problems after the event. And just to say that if a bookkeeper, the accounts team, have just charged VAT on rent because they think that VAT should be charged on rent, but the owner of the property hasn't made a conscious decision to opt to tax, then that isn't, just because you charge VAT on an invoice doesn't mean you've opted to tax. And therefore that's just an admin error, clerical error, and that cannot be cured retrospectively. You can opt to tax going forwards, but all the VAT you charged previously was wrong, and you have to basically get it back from HMRC and pay it back to the tenant that paid it to you. Now, the sort of example that HMRC has been looking at quite closely recently looks something like this. A company buys a commercial property for 500 grand plus VAT because the vendor opted to tax. The company claims back the input VAT on the basis that it claims it did opt to tax. But it doesn't, for whatever reason, notify HMRC of its option. A few months later, it gets an unexpected offer for the building for 600 grand plus VAT. So it charges VAT on the invoice because it believes it's opted to tax. It collects the 120 grand from the customer and pays it over to HMRC, or intends to do so, after it reports the sale in its next VAT return. In that situation, HMRC will argue very successfully that the option to tax was not valid because it wasn't notified, and therefore it never existed. And therefore, the input VAT the company recovered was incorrect, because actually selling the building without opting to tax it, assuming it was more than 3 years old at this point, would be an exempt supply. So you can't recover input VAT in connection with an exempt supply. That's a basic VAT rule. And it still has to pay over the 120 grand of output VAT that it's put on the invoice to the customer, because there's a provision in the VAT law in Schedule 11 that says that if you claim to charge VAT on an invoice, that is a debt that you owe HMRC. And that's to stop fraud, essentially. So anybody who puts VAT on an invoice when they're not VAT registered owes that VAT to HMRC, even though they're not registered. So the seller comes out rather badly, and HMRC will not allow the customer to recover that input VAT because it wasn't properly charged if no option to tax was notified to HMRC. Now, I imagine in most cases in this situation, the lawyers for the purchaser would not accept a VAT charge unless they saw evidence that the option had been notified to HMRC. But anybody who sells and anybody who buys without getting a lawyer to check the VAT is at risk of suffering these circumstances. And this is not made up. This was the basis of a real life case a few years ago that went to court. So I haven't just made up the example. This is real life. I've changed the numbers to make it easier, but it's a real life example that actually happened. In certain cases, options to tax are ignored for particular transactions. So you can opt to tax dwellings, you can opt to tax care homes, you can opt to tax charitable buildings, but while they're being used for that purpose, that option has no effect whatsoever. You cannot charge VAT, full stop. Secondly, if land has an option to tax on it, just bare land, so the vendor would ordinarily charge VAT on the sale, and the purchaser intends to build a dwelling to live in, or it's being sold to a housing association, then the option would be disapplied if the vendor is notified by the purchaser that they wish the vendor to set the option aside before the price is legally fixed. In England and Wales, that would be before exchange of contracts. In Scotland, it would be a different event that would fix the price. That's one situation where, even though the vendor has opted to tax the land, if the purchaser notifies them they're going to build their own house on the land, or they're going to build housing association property, then they can ask the vendor to set aside the option. If the vendor doesn't want to set aside the option, then the vendor has to sell to somebody else. Because once it's been agreed in the contract, that's it. Secondly, if a building is being sold by a vendor who has opted to tax, and the building wasn't designed as a dwelling, series of dwellings, charitable building, care home, and the purchaser has certified to the vendor that they intend to convert that building into dwellings, convert it into residential use, so care home, or convert it into a building for charitable purposes, then again, they can ask the vendor to set aside the option as long as they notify before the price is legally fixed, so it's built into the contract itself. If the purchaser doesn't notify before exchange of contracts or the price is fixed, then they can ask the vendor after exchange and before completion if the vendor wouldn't mind setting aside the option, but the vendor can refuse. Because the contract doesn't mention it. The vendor can refuse, or the vendor can accept a variation to the contract to include the setting aside. The vendor probably won't agree without compensation, if there would be an adverse capital goods scheme adjustment. They'll demand that any input VAT that they might now have to pay back, because they've set aside the option and are now making an exempt sale of buildings, they'll want compensation for that input tax clawback. So when it comes to the capital goods scheme, I mentioned briefly before, you judge the input tax recovery of land and buildings over a 10-year period. It's very common for businesses to believe they're not affected by that unless they make exempt supplies, which is largely true, but the sale of the property can be an exempt supply in itself. So although it's most commonly seen as annual adjustments to input VAT recovery, where the property has been purchased for more than £250,000, extended or renovated for more than £250,000, and been charged VAT, it also applies on sale. If the property is sold within the 10-year period, then there's a final adjustment that affects all businesses potentially, whether they're partially exempt or not. Because if that property is sold as an exempt supply, then for the remaining number of whole years left of the 10 years, it is assumed that for the remainder of those whole 10 years, you would have used the building 100% for exempt purposes, even if you've been using it 100% for taxable purposes previously. If you sell it as a taxable supply, so it's still within 3 years of being constructed, or you've opted to tax as a vendor, then you would be deemed to have used it 100% for taxable purposes for the remainder of the 10-year period. And if you're partially exempt as a trader, you might be able to recover a bit more VAT that relates to that building. So just as an example, Esme, I'll come back to you very shortly. Thanks for the question. A fully taxable business buys a new commercial building for £1 million plus VAT, recovers the 200 VAT in its VAT return because it uses the building for 100% taxable purposes. Perhaps it's got a trade or a profession. Perhaps it's your company that's bought this building and you're making 100% taxable supplies. 5.5 years later, sells the property for 1.3 million. So what are the VAT implications if, first of all, the business hadn't opted to tax the building when it sold it, or opts to tax it just before it sells? Well, if it doesn't opt to tax and sells the property 5.5 years later, by definition, the property must be more than 3 years old, so it'll be an exempt supply. Therefore, the company will have been presumed to have used the building 100% for exempt supplies for the remainder of the adjustment period. Well, it's 4.5 years left, so that's 4 whole years, and it means that the vendor is now going to have to pay back 4/10 of the original VAT it recovered when it purchased, so 80 grand. If it opts to tax the building just before it sells it, notifies that option, and it then charges output VAT on the selling price, then there won't be a clawback of any of the original input VAT. And had it been partially exempt and only claiming back, let's say, an average of about 65% of the input VAT so far, for the remaining 4 years, the annual adjustment would have been presumed to be 100% taxable. So therefore, would allow an extra recovery of input VAT in the VAT period when the property was sold. Now the question, Esme, sorry about that. Does disapplying the option to tax for notifications take precedence over about having to keep opt to tax for a minimum 10 years? Yeah, it is 10 years. 10 years? Yeah, it is 10 years, Esme. So, it's 10 years, 20 years? I think it's, let me come back to that in a moment. Sorry, I've been sidetracked. Disapplying the option only applies to that one transaction. In other words, the option's still there. You haven't revoked the option. You've just set it aside for a single transaction. Okay? As far as the law is concerned, the vendor has still opted to tax that property. Of course, if the vendor disposes of that interest, thank you very much, Madam. 20 years, not 10 years. Very good. Sorry, temporary brain freeze. So the vendor, of course, has sold the building or the land and therefore no longer has an ownership interest in it. but their option to tax is still there. And the law says that that option to tax remains for a further 6 years. So if they were to somehow have any transaction to do with that land over the next 6 years, then they would still, the options tax would still apply to that transaction. So it doesn't affect the options tax. The options tax still exists at that point. It's just set aside for that particular transaction. Now, the last thing to talk about with land and buildings is transfer of going concern. Sometimes that can get a bit fiddly, leaving the vendor with a VAT liability they weren't expecting. So generally speaking, the transfer of a going concern business is not considered to be a supply of goods nor a supply of services. So it's outside the scope of VAT, subject to certain conditions. The purchaser must be or become VAT registered as a result of the transaction, and they have to carry on the business as a going concern, carry on the same type of business with the assets. However, if the assets transferred include land and buildings, VAT might be chargeable on the land and buildings transferred, never on the other assets, just the land and buildings. So, in what situation would that arise? The first thing you consider, if they weren't selling the business as a going concern, they were just selling the land and buildings, would they be charging VAT on that transaction? Well, if they've opted to tax, the chances are yes. But if this is the second or subsequent selling of the freehold in residential buildings or care homes, then the answer is no. It will be an exempt supply. So we have to think about that quite carefully. If they would charge VAT on a standalone sale of the land and buildings without selling the business, then they would charge VAT when they are selling the land and buildings as part of the business, unless the purchaser opts to tax those land and buildings before the sale takes place and notifies HMRC they've opted to tax the land and buildings and sends the vendor a copy of the reply email from HMRC confirming that they have notified. If the vendor is satisfied that the purchaser has opted, notified, then the land and buildings are outside the scope of VAT, along with all the other assets transferred. So that is a bit fiddly, but when you've dealt with it a few times, it actually becomes fairly standard stuff, fairly easy to remember. If the purchaser is 100% taxable, they may not be concerned about being charged VAT on the land and buildings, because they can recover that VAT if they're a taxable business, but they will have to pay SDLT on the consideration they pay for the building, and if that includes VAT, then so be it, they pay SDLT on the VAT inclusive price. If you work in the charity sector, that can get a bit awkward. Just because a charity occupies a building doesn't mean they're using it for charitable purposes. Back office activities, admin activities, are not charitable activities. And so if I was renting an office to your charity and you were using it for admin and I had opted to tax the building, I would have to charge you VAT. If you were using it for charitable purposes to advance the primary objectives of your charity, I couldn't charge you VAT, because the options tax doesn't apply to dwellings, residential purpose buildings like care homes, nor charitable use buildings. And also, if a builder is constructing a new building for a charity and seeking knowledge about whether they can zero rate the supply, the builder has to ask the charity, when this building is finished and you use it for your charitable purposes, do you intend to charge your service users to use this building? Are you going to make like a nominal charge perhaps for them to use the building? And if the charity is going to charge their users to use the building, not a market price, but a nominal price, and it's a way of trying to raise a bit more income for the charity, then that charity is making a supply to the users in the course of a business for VAT purposes, and therefore it's not a charitable building. It's actually, for VAT purposes, a commercial building. And therefore, the construction of it has to be standard rated, because only the construction of dwellings, care homes, and building charitable use buildings are zero rated. The building of commercial buildings is always standard rated. There's precedent case law that covers it. The Longridge on the Thames case is the one to Google to find out more about that. Okay, so that's a bit about land and buildings, just to remind you about some of the key principles. With a fundamental knowledge of VAT that I've covered today, you can normally answer about 90% of VAT queries that come your way. There are some subtleties here and there, but fundamentally, that's what you need to know. Caroline, what if a charity asks users for a donation for the use of the building? Yeah, that's a rather subtle point. If they ask a donation, but they don't treat the people who don't donate any differently from the people who do donate, then it is a genuine donation, and a donation is not a supply for VAT purposes. If they say suggested donation, and if you don't donate, that's fine, do come in, enjoy everything, no problem. If they say that there's a minimum donation, then that certainly is a supply for, of services. If go into one part of the building, and the people who do make a donation go into another part of the building, a better part of the building, then the people who are paying for a service. And again, it would be a business supply, and the building would be considered to be a commercial building. So it's a bit nuanced, but if it's a genuine donation and the charity will not penalise somebody who doesn't make the donation, then donations are outside the scope of VAT. They don't interfere with any VAT law as far as charities are concerned. Okay, we've got just over 10 minutes left. So let's just cover business splitting and see whether we can cover anything on place of supply of services, although we did cover that in some detail when we talked about the change to live events earlier. Oh, Graham, I haven't even started yet. So perhaps I can just cover business splitting and then perhaps come back to the question you put in the Q&A, if that's okay. I hope that's okay. Obviously, been waiting for this moment, and I apologise it's taken so long to get here. So let's just cover business splitting, and I'll try and answer Graham's question in the Q&A afterwards, which no, I think nobody else can see, so I'll read it out later. So HMRC has the power to issue a business splitting direction. I put the legislative reference on there. And that's normally going to happen when, excuse me, two legal entities are carrying out parts of what might be the same trade concurrently. So you might have in a pub the drink sales being made by a VAT registered sole trader, and the food sales are being made by a non-VAT registered spouse, because the drink sales perhaps are above the VAT limit and the food sales are below the VAT limit. If that's the case, then HMRC would probably argue that the supplies are being artificially split, and they can issue what's called an aggregation direction. If that happens, then the VAT registered spouse would have to deregister, because if they're running what is essentially one business as a husband and wife team, that's a partnership, so they have to register the partnership separately for VAT purposes. The good thing about aggregation directions is they can never be backdated. They only take effect from the date the direction is issued, or a later date if that notice specifies so. So, in other situations, the law allows HMRC to issue a similar direction to any persons who are closely bound to one another by financial, economic, and organisational links. You can find those definitions, by the way, in rather strangely in the National Insurance Contribution Act of 2014, because they are all links which cause the employment allowance to be split between different employers. So whether there are financial links, the one is financially dependent on the other in some way. Economic links, they both are trying to achieve the same overall economic objective. Or organizational links, they use the same premises, they use the same service, the same customers, they use the same equipment. That's organizational links. And HMRC can issue a direction where two separate persons are closely bound, where those separate people, including companies, carry on activities in which they make taxable supplies for part of the activities, whilst the activities carried on concurrently by somebody else are not taxable supplies. Now, this is going to be more of a risk with newly incorporated companies when the incorporation is prompted by a desire to delay VAT registration. The effect of the direction in this case would be again to aggregate the turnover of the current and previous businesses when considering whether they breach the £90,000 limit over 12 consecutive months. That might give an impression that it's being applied retrospectively. Okay, it is not. So let me just show you this example, and then I'll hopefully tackle the questions that have come in on the Q&As. So let's say that we have a sole trader who's in the 12 months to July 24 has generated turnover of just below the 90 grand registration limit, 89.4, so 7,450 a month. There's a new client, which means that income will now increase to 9 grand a month from the 1st of September 24. So to avoid having to register too early, the client incorporates on the 1st of July 24. The newly formed company doesn't inherit the sole trader turnover, so the trader appears to have started afresh, brand new, for registration purposes. But HMRC opens an inquiry, visits the business, and believes that an aggregation direction is appropriate. It visits in December 24, and it issues a direction for aggregation in January 25. If the sole trader business had continued, we can show that mathematically the sole trader business would have breached the registration limit on the 30th September 24. That's when their previous 12 months turnover would exceed 90 grand. And they would have a registration date, therefore, of the 1st of November. They'd have 30 days to notify and be registered from the start of the following month. For the direction to have the same result, it would have to have retrospective effect. It can't. And therefore, the result of the direction is to give an effective registration date of the 1st of January 25 at the absolute earliest. So incorporating to delay VAT registration can work, does work. It depends how quickly HMRC picks up on it and has the ability to issue an aggregation direction. We have to make sure that there are good commercial reasons for making the transfer or incorporating. There can be limited liability, reputation, running a company rather than a sole trader, and so on. Okay, cool. In very rare circumstances, HMRC does have the ability to register a person from an earlier date on the basis that there had only ever been one business, rather than two separate businesses claimed by the taxpayer, which have been artificially separated. So, for example, if a person forms a company, thereafter running two businesses, selling a service to non-business clients as a sole trader at below 90 grand a year, selling the exact same service to business clients through a limited company, either below or above the threshold, but if they're above, it doesn't really matter because they're servicing business customers who might well be VAT registered, then they can recover the input VAT they're being charged. Then if HMRC sees this, they are allowed to say that in essence, there was only ever one business. They can backdate the date of registration. They can charge the VAT that should have been charged on the combined business, along with penalties and interest to boot. And HMRC is able to go back up to 20 years in this case, where you should have been registered and you didn't register. HMRC can go back 20 years, okay, 20 years, even in cases where it wasn't done necessarily deliberately, knowingly, they can still go back 20 years. Okay, we've got 3 questions come in on the Q&As. So Graham, first of all, with regard to business splitting, if a planning consultant has two elements to their work in two different legal entities, private client applications for planning against work for a public authority, when working for the authority, they cannot send private planning applications for assessment to that authority. Hope that makes sense. Okay, so Graham, I can't answer the question. I'm not an expert in that area, in terms of the commercial area, but the only risk they might have is if they would fall foul of this sort of situation here. If they're providing an identical service to individuals than they're providing to public authorities, and they're doing it to keep one of them below the VAT threshold, so they don't have to charge individuals VAT, then that might be an issue. But if this work is different work, because the customers they have require different things, then I don't think they have a problem, because they're supplying different things. I hope that helps somehow. Zara, a charity dog home uses part of the building for commercial dog rest home, charging the going rate. Is that part VAT chargeable? Well, that depends, Zara. What are they charging for? Because I would equate that, in my opinion, to looking after horses in a stable where you provide them with food and exercise and stuff, and that would be taxable activity, providing a livery business in the horse world. So I don't, Zara, I don't think you can honestly, hand on heart, saying that they're renting a space. They're providing services for consideration, and I think that would be VATable at the standard rate if they exceed the VAT registration threshold. So that's that one done. That's that one done. Mark, wouldn't the TOGC rules mean the limited company would take over the turnover of the sole trader and therefore need to register on day one? You're talking about the example we looked at just before. Let me just come back to that example. Hopefully. Brilliant. It's frozen. Helpful. So this example here, it's not necessarily the transfer of a going concern business if they claim they're sort of starting again. I take your point, and when I first came across this kind of scenario, it did occur to me that TOGC might apply. If there are no chargeable assets being moved across, VATable assets being moved across, then TOGC becomes a bit of a moot point from that perspective. So I suppose, Mark, my answer would be possibly, depending on the circumstances. And James, if a sole trader business is being sold, is VAT payable on the goodwill? Well, that ties in with the TOGC question asked by Mark, so very, very handy there. So the basic answer is yes, by the way. Goodwill, the sale of goodwill, is a VATable supply at the standard rate. However, if the business is being transferred as a going concern, and almost by definition, if you're transferring the goodwill, you are transferring a going concern, then that would take it outside the scope of VAT. So technically, yes, but in practice, being part of the transfer of a going concern business, the answer would almost always be no. You don't have to charge VAT, because it is if they don't meet the TOGC conditions, then that will be charged on the goodwill. Definitely. Okay, we've reached our midday finish time, which means we don't unfortunately have a chance to go into cross-border services in any more detail than we covered them before. So all I'll say, the most important thing is to identify the place of supply of services, because that tells you which jurisdictions VAT applies. There are special rules that can apply to certain services, sometimes whoever they're supplied to, sometimes if they're just supplied to business customers, and sometimes if they're just supplied to non-business customers. They are contained within Schedule 4A of the VAT Act. Make sure if you're looking at cross-border services, you identify first and foremost of supply. Look at Schedule 4A. If the transaction's on the list, that's the place. If it's not, default to the general rules. Supplies to business customers where the customer is established. Supplies to non-business customers where the supplier is established. Once you've established the place of supply, that country's VAT system applies. If that's not the UK, if the customer is a business customer, they account for the VAT. But if that country's customer is not a business customer, we as the supplier in the UK have to, by hook or by crook, account for the VAT in that country. These days, almost certainly by using a one-stop shop that I described earlier. Okay, well, we did start 1 or 2 minutes late, so I've taken a bit of a liberty to finish 1 or 2 minutes late. But that is our latest VAT update and current hot topics. I hope it was useful. Thank you very much for the questions, and thank you very much for keeping them on point as well. They were very good questions related to what we were covering. I think that enhanced the session as well. So I'll hopefully see you at some point in the not distant future, but I hope that you've enjoyed the session and you can use the results of it to help clients, help yourselves generate more revenues for your business. Have a good afternoon. Have a great weekend, everybody.